All right. Well, thank you everyone for attending this month's market update webinar for October 2023. Let's start with disclosures. So Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only. It does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can see our website for additional disclosures, and throughout the webinar, if you have any questions, please use the Q&A button at the bottom. Quick bio. My name is Jeremy Eppley. I'm a certified financial planner, accredited investment fiduciary, accredited portfolio management advisor, and chartered retirement planning counselor. You can learn more about me on my LinkedIn. And Silverstone Financial is a fee-only fiduciary registered investment advisor. We provide comprehensive wealth management services, including financial planning, investment management, and tax and estate services. You can learn more about us on our website. So I'm really excited about this month. Last month, I had described it as a boring month for finance, but a lot of stuff happened. Not necessarily good stuff, but a lot of stuff that kept me quite busy and at least entertained. The biggest, most impactful, since everyone's been watching it like a hawk, is the inflation announcement, the inflation read that happens each month. And so in September, the August inflation announcement came out, and you got to remember that it is a little bit delayed. We're talking about it in October. It was the August inflation that came out in September, so at least a month and a half delay, and oftentimes these things have revisions that happen afterward. But it turned out being slightly hotter than expected. We had 3.6 down here. Projected, but instead we got a 3.7 read. Not the biggest deal. However, it definitely upset some of the markets, making those worried about the Federal Reserve. A lot of people, a lot of analysts, a lot of commentators expected the Federal Reserve to start cutting interest rates pretty soon in 2024. And alongside the Federal Reserve meeting and their announcements, there's some fears that the cuts won't be as soon as possible, which caused some people to get jittery. So we'll definitely talk about performance in the markets in a little bit, but it wasn't the prettiest month, but it was interesting. There weren't that many IPOs this year, unlike the previous years where it was IPO and SPAC galore, where there was a lot of private companies becoming public in various different ways. A lot of money being thrown at them. We've been waiting for a while, and this month we had two very, very large ones. Instacart IPO'd at about $10 billion. Since then, it dropped almost 20-25%, simply because the market's down and IPOs are usually pretty volatile at the beginning of their debut, and it's 10 to 7.5 billion or something like that. So you lost $2.5 billion. It happens to everyone. The ARM IPO, though, a lot of you might not be familiar with the company, but it's a very large, very important company. So ARM Holdings, it's a British company that is mostly owned, or at least invested in, by SoftBank, which is they have a very large, I think they call it Vision fund, which is it's a Japanese investment, like very, very large investment company that had invested in hyper growth companies. ARM's a semiconductor, so the chips in your phones and your computers, they design those and then license out the designs to different companies like Apple and Nvidia and such. And ARM, without getting too much into it, if there are definitely videos on YouTube and other kind of news articles about it, but ARM has so much drama behind it, specifically like there's this weird law, and I forget which company it was Singapore or Hong Kong or something, but like you have to, the ownership has to be served with a specific kind of paper, and the owner, like the CEO or whatever, like refused to give up his uh, his position or something like that. It's been a company that is very powerful, very important, and also pretty entertaining if you are interested in digging into ARM as a company. But together, $64 billion in IPO money, a big splash. I haven't seen that much activity in a while. So again, interesting, not necessarily that important, but very interesting for those that follow the markets. The other thing that's happening, of course, are all these strikes. The ones that we had been talking about for a while were the streaming strikes with the Writers Guild and the Actors Guild kind of being in conjunction. And the Writers Guild strike, from my understanding, has ended. They signed a deal that no one's particularly happy with, which means usually that's a good compromise. And the Actors Guild strike is apparently, from my understanding, again, I'm not an expert, but they are in their final talks to wrap up pretty soon. But one that's still ongoing, the UAW, the United Auto Workers strike, which is GM and Ford, I believe, and a few others. Um, it's still ongoing, like strong gridlock of uh, no one conceding anything. I believe a lot of the union workers in the auto plants were laid off, and we'll see how that has effects on all these companies. I don't usually speak too much about individual companies, and strikes are also not something I'm an expert in, so I won't be answering any questions about like, do I buy Ford or GM, or do I sell Ford or GM? Uh, Honestly, I'm not sure. I That's not my expertise. But in terms of what it had, the implications it has on the broader economy, it's interesting to see these large profile strikes happening, because what it's showing is, with inflation up, uh, of course, buying power is eroded. So all these workers that work on fixed incomes, like the United Auto Workers, for this example, um, everything's become more expensive, and wages haven't kept up. And with all the rate hikes and such, there's different power dynamics going on, where the workers are trying to get more concessions to help them keep up with inflation, and then at the same time, some of these interest rates are working against them. So if we will see ongoing strikes pop up between different, maybe we'll see. There was a lot of talk last year about Amazon and Starbucks forming unions. Will we see strikes that pop up, or strikes that pop up in other industries that are common to have unions? I don't know. It'll be very, very interesting to see. And I'm also just curious how long the auto workers can stay on strike for, because the longer that lasts, it could have serious implications on the new car market, which also trickles down to the used car market. And for those of you that need a new car or want a new car, it could have actual direct impact to that purchase price. We'll see. And the final one, we had a lot of a lot of interesting uh, uh, events happen this month. Was the government shutdown, or at least the almost government shutdown. From my understanding, it was like 15 minutes, avoided by 15 minutes, for when Biden actually signed the bill. It was like signed at 11:45 at night, and the government shutdown would have been triggered at midnight. Um, uh, McCarthy, which is the Republican Speaker of the House, ended up having to uh, work with Democrats. Not He didn't want to, but he ended up having to get around the more radical parts of his party. And what they came up with was a 45-day extension. So instead of buying what you need, just renting it and kicking it down the road. So we'll see what happens in 45 days. But those that this is not a political webinar, it's a finance webinar, but seeing that this cost McCarthy his job, at least temporarily. He was ousted, I think, yesterday or the day before, on the no confidence vote. Again, I don't know. I think I read a headline somewhere that it was the first time ever a speaker was ousted on a no confidence vote, so historic. But there could be a real impact on the markets here. We definitely saw some volatility and some selling off. I don't know if it was directly due to the government shutdowns, the government turmoils, anything like that. But in 45 days before the end of the year, this is all going to come up again. And when McCarthy first had to be elected speaker, it took 10 votes or 15 votes or something like that, and it took many days. And here, that there's an equal chance that this is going to go on for a while. And will they have this resolved by 45, like day 45? And like they first have to resolve the speakership, and then they have to come up with a compromise with the people that didn't want to compromise in the first place. Um, it's going to be very interesting. It kind of, when I look at the markets and I talk to clients about what to expect, should I be worried? That's a lot of the conversations I have about like fear in the markets and trying to get some sort of reassurance. Um, Historically, we're going to talk about it a bit about cyclicality in the markets, normal seasonal movements. The end of the year is very good, and I believe it likely will be. But there is definitely this large question mark, or at least large risk associated with that might mess up the nice end of year rally that a lot of us would be hoping for. Again, it doesn't mean that I'm recommending anyone sell things or panic. Usually, I try to reassure people that long-term investing, sticking with it, has the best outcomes than trying to time the market or trying to save your investments from some potential risk that actually hasn't happened yet. So a lot of fun events. Hopefully, this is hard to say because I'm gonna say hopefully next month we'll have just as many fun events to talk about. But from a finance perspective, from a investment manager's perspective, it's probably better if we don't. If I had mentioned last month a few times, like it was a boring month, but boring is usually good. This was an exciting month and not necessarily a good thing. Uh, we'll see how it goes though. Quick slide on the Federal Reserve announcement. In September, they announced that they weren't going to do a rate hike. They also didn't announce a rate cut, but that wasn't really on the table, as it will be for the rest of the year. Is kind of, are they going to pause for the meeting, or are they going to do a small 25 basis point hike? Um, we're just going to have to keep watching and hoping for the best, and we can't we can't say much more about that. There's basically, it seems they've got to a cadence of every other meeting, 25 nothing, 25 nothing. Maybe we'll have a 25 basis point hike in November. Honestly, a lot of people don't know what to expect. A lot of the Federal Reserve, like their wording behind it all, is we want to see what inflation does. Now, last month inflation wasn't great. Um, the inflation rate read came out right before the September meeting. Some people expected, well, if we had a hot inflation, they're going to do another basis point hike. From a lot of the commentators, what they were saying after the announcement from the Federal Reserve happened that they didn't do a hike, a lot of people expected, oh, well, if they're not doing a hike here, it's most likely they didn't want to shock the market by being too reactive to a single inflation data point. And the expectation is there'll be another rate hike in November. We'll see. Mostly, I think we're getting, again, moving away from what the Federal Reserve is doing and caring more about what the inflation is doing. So I won't spend as much time talking about all this. On the side here, also, you see the September economic projections compared to what the June economic projections. Every 3 months, they come out with these projections of where the members of the committee expect the interest rate to be. And we saw 2026 numbers for the first time. Most of the 2024, 2025 numbers were about the same as before, where we expect a few rate cuts in 2024 and then more significant rate cuts by 2025, bring it back closer to the longer run neutral rate. Again, not that important for the average investor, but interesting for those that follow it closely. So We got to the very red screen here, the September heat map. For those that haven't seen this depiction of the market before, each box is a company. The larger the box, the larger the company. The redder the box, the more losses it had. The greener the box, the more gains it had. And it's separated into the 11 different sectors of the economy. This month was a pretty bad month. Seeing the S&P 500 go down by almost 5% a month is usually quite bad. Usually painful for those that follow the markets, and painful for those that like to try to time the markets. If you got on the wrong side of it, it could definitely have lost you quite a bit of money. But again, sticking with it long term, there's a lot to, even though there's some fears associated with the whole government shutdown potential, there's still a lot to be not necessarily grateful about, but a lot to be positive about for the end of the year, which we're going to get to. Quickly, the Dow Jones down about 3.5%, S&P 500, and the mega cap names down almost 5%. Small caps doing even worse, being down about 6%. Global actually performing a little bit better, but they're also not being jostled around as much by the government shutdown, because they're not in the U.S. But still, the global economy being down about what the Dow Jones was, about 3.5%. Bonds total return down about 2%. Gold, interestingly, also usually when there's volatility, gold is a winner, but down 5% for the month. Oil bumped up a little bit. This had to do with some politics with OPEC and the Saudis and Russia and such. It didn't really have, from my understanding, didn't have as much to do with demand or anything like that. It was mostly to do with geopolitics. And up or down 10%, it is significant, but oil moves quite a bit, so I wouldn't worry too much about that exact number. And Bitcoin being one of the most flat, least volatile out of all the things here, other than bonds being the most stable at up 3%. Interesting to see. I think that has a lot to do with the continuation of the spot Bitcoin ETF debate. I talked a little bit about it last month, I believe. I might bring it up in the future, but there's legal action against the SEC and by the SEC against these fund managers who are trying to make spot Bitcoin ETFs happen. We'll see what happens. Again, doesn't affect too much the average investor. Year to date, a little bit greener, mostly the mega caps. It's been very interesting to see how much the mega caps have outperformed the general S&P 500. I like the Magnificent Seven used to be the FANG stocks, but now that Tesla is a thing and Nvidia is a thing, where they're one of the mega caps. It's usually, I've been hearing people say the Magnificent Seven, so Amazon, Tesla, Meta, which is Facebook, Google, Apple, Microsoft, and Nvidia. Those very, very large companies. Those have been basically carrying the S&P 500, with the regional banks still having done terribly from the beginning of the year, mostly because of the bank crisis and some failures and such there. Small caps, which is made up of not mostly, but a large chunk of banks, which is why they've performed significantly worse than the rest, actually having lost money year to date, even though the mega caps are up almost 25%, which is a huge number year to date. The ex-US, so international stocks, about 3% in comparison to the 11% of the S&P 500, and bonds being pretty flat, gold being pretty flat, oil, I'm going to say, being pretty flat. It's a larger number at 13%, but still oil is pretty volatile. And the biggest winner being Bitcoin, because of some things that had happened earlier in the year, which we talked about in previous webinars, even though it didn't do that much this month. So this next slide, I've shown you this every month, but I added a little bit extra, so it's a little bit busier, but I'll explain it all here. So this is the historic cyclicality of the markets. So the market is seasonal. Each month, on average, some perform better or worse September, which I had warned during the last webinar, that September historically is the worst month, and that if we see a down market, you shouldn't necessarily fear everything. There is some just, this is kind of the month where there's a sell-off, and you should expect it and accept it and move on. We did have a quite a bad month, being down almost 5%. To note, this is down 5%, and the average is down 0.5%. But all the numbers, the inside numbers are what actually happened. The outside numbers are the averages over like almost 100 years. What's important to note is, since they're averages, almost always each of these months, they're as volatile as what's being shown here. So the volatility isn't anything specifically new. It's actually pretty average this year. But since, there are some months, some years where the September is good, and there are other months that September is bad, when you average it, the volatility seems much lower. But in reality, it's acting pretty normal. August, September, we had down months. February, we had a down month, which historically is a pretty flat month. So it's kind of a toss-up, a coin flip. The big upset of the year was in June, where normally we have, a coin flip, down 1.1%. But we had a huge rally in June, which I can show you on the chart in this next slide, where that happened. But all I'm saying here is, because there's a normal cyclicality, and we've been following it, and I had said in previous webinars that there's not too much to be worried about, like bar what's called a black swan event. So something that happens that doesn't happen very often, has a big impact in the markets, and you couldn't have expected it. Like bar China invading Taiwan, or another pandemic, or some sort of like spillover, like terrible war thing that happens in Ukraine that goes into the rest of Europe, or some sort of terrorist act. There's a ton of unforeseeable risks that unfortunately exist in the world. Usually markets act pretty similarly. Now those things can happen in October and derail the rest of the year. Like the biggest one would be if in November, 45 days from now, there's like a real bad government shutdown where there's a ton of gridlock and no one's happy with each other. Like it could end up having where these last 3 months are all red as well. However, I feel that based off the technicals, which we're going to get to in the next slide, more likely than not, again, in finance, like a good chance is like 60% chance, so better than a coin flip. More likely than not, we'll have a nice end of the year rally, which should help make us forget that this month was a little bit tough. Next month, I'll bring this up, and I'll explain a little bit more about some of these months and what to expect, and how it all comes together when you look at cyclicality, seasonality of the market. But for now, hopefully, everyone understands the point I was trying to make with this kind of busy chart, but important chart to help understand. All right, this is our last slide, what we normally do here, which hopefully not overly technical for some people, but this is the S&P 500. It's showing a candle chart, which is either green or red based off of if the day had a gain or a loss, and sometimes has what these are called wicks. So for a candle and then a wick, very tall lines that go up and down, and that kind of shows the volatility in the day, where how high it could have or did get during the day. Most of you can just read it as a normal line chart. This was the beginning of the year. Around like March or April, I put these lines up, which were a range that I had identified where I was expecting at the time. So again, in June, when I was saying, well, we've been trading this range pretty consistently, where we've been hitting the bottom at 3,800 and hitting the top at 4,200. And there's in finance called ceilings and floors, and resistance and support. So there's a large group of people that are on the sidelines waiting for it to get a certain point, and then they're willing to buy in. And there are other people that are like fearful, and that first one's called support. There are other people that are fearful as it gets closer to a point that we've never reached before. So like if we keep hitting this point at 4,200, people know that. So they're like, well, as soon as you get back to 4,200, I'm done. I need to get out of the market. I'll sell. And then there's downward pressure. So kind of a self-fulfilling prophecy. If people are fearful of the market, it causes bad things to happen, which then causes the market to go down. So we were trading in a range, and right in June, I had been talking about, anything can happen. Again, coin flips, but more likely than not, I saw the market go down. Like we'd probably stay in the range and such. Now, another finance term, sometimes you break out of range. When you break out of range significantly, the range no longer really applies. Like it's a new paradigm. You got to understand that trying to justify market moves based off of old analysis that no longer applies usually is a fool's errand. It doesn't hold weight, and you can't control the markets. You can't force it to do what you want. So you just got to understand, okay, when June hit, we broke out. This, of course, was the really big month. Again, cyclicality of the markets. That was one of the points I had made at the time. Was like, well, usually June's a down month, or at least a flat month. But we had, for a number of reasons, a big gain here, and it continued into July. Since in July, I had thought, like, since we had been trading in a range and we were getting to a point where we're kind of overbought, so stocks are getting expensive for the amount of earnings and growth that was expected of them. I was saying the end of July, it's great to have seen these gains, but know that there's a chance that we might be giving up some of these returns. Again, perfectly natural, perfectly normal, nothing to worry about, not something that you should fear sell out of the markets, but just to understand. So I've been talking that at the end of July, around this line, I was like, we're likely going to see some market sell-off, and we did. And of course, August historically is a slightly down month. Now, last September, or at the beginning of September, end of August, last webinar, I had talked about the chances and my expectation that we would continue to see markets go down. Of course, I was hoping for the best, but I was saying more likely than not, the markets would fall. For any of you guys that want to go see what I had said previously, all these webinars are recorded on my YouTube channel, Silverstone Financial. Sometimes people will make fun of me because I made a bad call. Other times they're like, well, how do you know? Again, a lot of these are just predictions, and nothing's guaranteed. And probabilities are like 60% or 70%. Like that's a really good probability. But August, we expected to go down. We had a nice kind of rally at the end of August, and then I expected September to go down again. We've gotten to a point where, based off of how inflation has acted and how there's fear that inflation was going to come back, or that the Federal Reserve would have to hike rates more, and that we would never get the soft landing, which we talked a lot about in 2022. It seems like we're getting to that soft landing, and as time progresses, we have more and more confidence to say that. So, because when we have more confidence to say that, the expectations for these stocks go up. So even if the prices fluctuate, expectations usually are pretty stable. All that said, hopefully I didn't lose you with that rambling there, but I'm thinking that we're probably reaching a bottom soon. Especially these past few days was pretty bad. We could have some more pain this month. Again, definitely no guarantees. But usually the last 3 months of the year, so October, November, December, are the best months in the year. And I know there's a lot of pent-up demand and money on the sidelines waiting to get back in. Usually when people are looking at technical analysis, which I am not an expert in, and I don't necessarily recommend trying to time the markets. This is mostly educational and trying to dispel the myths of like everything's happening for no reason, that the markets are scary. This is mostly trying to make people feel more comfortable about investing and feel more comfortable about staying in it the long term. All that said, I expect, if I had to make a call, again, not an expert, I would say we'll probably end the year back at the peaks we saw in the end of July. where we go back out to about 4,600, and that's about a 5%, 6% increase, and make up some of the losses we had. Now, 2024, I'm not even going to try to make predictions because that will be up to if and when we have rate cuts, and also if and how the inflation is staying down, how it's handling everything. So I'll say, stick it out. Hopefully, don't feel too bad about this month, or past month, September, and hopefully this next leg in October, in November, and December will look really good. Hopefully, all that made sense, and hopefully it makes people feel more confident about investing and more confident in the markets and such. Now, I haven't seen any Q&As come in so far. Hopefully that's because I was clear with what I was saying, not because people were disengaged. But if you have any questions, please submit them. I'll wait about a minute. But if not, then I'll wrap up the webinar for the night. I really appreciate all you attending. We'll definitely see you next month, hopefully with good news, which I do expect, and I look forward to giving that good news of we recovered a little bit, and the markets aren't that scary, and they're not that irrational. So, yeah, I haven't seen any questions come in, so I'll wrap it up. Thank you, everyone. Have a great night, and have a great October.